Okay, now I see. Thank you. All right, guys. Good evening, everyone, and then welcome back to our class. So, the plan literally is to repeat the class in order to catch up with those that missed the class. But yeah, we still have like the same people that attended last session. So, what are your suggestions in this case? Are we going to proceed from where we stop, or we can just have a quick recap and then continue from where we stop? Can you hear me?
Yeah,
Yeah. So, uh, particularly, Mr. Osahon, are we going to start all over, or just have a quick recap and then continue from where we stop?
I don't understand.
So the plan initially is to repeat the class. I mean, what we have done last week, because of those that missed the
Okay.
class, we consider that since it's the first class, some people may miss due to maybe not communicating the link earlier. But we
Yeah.
still, it turns out that we still have like the same people that joined last week. So which is particularly you.
Yeah, we can continue.
Okay, so yeah, we can
And
continue from.
the constraint we have then is that the first class was not recorded. You know.
Yes, yes. So therefore, we are going to record. We will have this class recorded. So if I mean, for this reason, then we have to, maybe we can repeat the whole session, and then if time permit, then we can continue. Right?
Okay. Okay.
Yeah. Thank you. So yeah, I will
Okay.
share my screen in a few minutes. I'll just dig out the slide from my system. Mhm. All right. Okay. Share. So. All right. So please let me know if you can see my screen.
Yeah, I can see it.
Thank you for confirming. All right. So today also we are going to look at introduction to risk assessment, just like we did last week. So talking about risk assessment is an important part of risk management, because by the time you know something, you can be able to solve it, and what you don't know is actually bigger than you. Yeah. So um, it's why. Okay. I see. All right. So our plan is to understand what is risk assessment, look at some real life example of quantitative risk assessment. We see some Python code. We also see some geometric Brownian motion, which is also part of modeling techniques we use in minimizing or in assessing some risks. Yeah. Then if time permit, we are going to look at qualitative risk analysis. Yeah. Okay. So risk assessment, as the name implies, when we say assessment, trying to quantify or measure something. So here we have two words, risk and assessment. What is risk? Risk is anything that can expose an individual, organization, or company uh, to a potential risk, to a potential threat, hazard, or uncertainty. So, and then the impact of this is usually negative. So that is why we are trying to assess the risks, and then by the time we assess the risks, then we can mitigate. Okay, it involves identifying, analyzing, and prioritizing these risks to make informed decision. So if you identify some potential risks, then you can be able to decide what to do, what are the measures to be taken, or what are the necessary things that you need to do as an organization or as individual or government. All right. So companies, government, and investors conduct risk assessment before embarking on a new project, business, or investment. Yeah, as we all know, today people are into investment. Government are into new project, implementing new policies. Companies are into expanding their business, bringing in new things, doing so many business analytic, and then improving their operations. So in all this, risks are involved. In throughout the operation, risks are involved. I can say that in general, in every activities we are doing today, whether it is business operation or even our daily day-to-day activity, there are risks involved. Just the most important thing is to identify those risks, and then you can plan how to mitigate the risks for present and future. So risk assessment enable corporations, government, and investors to assess the probability that an adverse event might negatively impact a business, economy, project, or investment. So risk analysis provide different approach. Individual or organization can use to assess risks of a potential investment, project, or any activity. So in general here, we are just giving a general overview of risk assessment, particularly in government. But the plan for the course is to focus on insurance companies and also banking industries. Yeah. So, all right, let's move on. Then risk can be evaluated and prioritized using a variety of ways, depending on how well the risk is known and how quickly it can be analyzed and prioritized. It may be able to lessen the potential negative impact or increase the potential good effect and take advantage on the opportunities. Yeah, so that is, I mean, here we are talking about the importance of doing risk assessment. One is to mitigate negative impact, possible uh, negative outcome, potential damage that that can happen. Yeah, so that is first part of it. The second part of it is that by the time you assess risks and you mitigate some problem, then you will be able to have a positive impact, or you can improve, you can optimize your way of operation by assessing your risks and then mitigating them. Yeah, so positive and negative, you know. So negative we eradicate, positive we have it in system or in place. So in general, we have two types of risk assessment or analysis. First, we have the quantitative risk analysis, and then the second, we have the qualitative. So quantitative is simply using mathematical approach. Mostly today, because of we are into a data-driven era, and then also technological era, we see that most of the models we develop, we use computer system, mostly programming, and in some cases, so many companies develop softwares to mitigate for to perform their risk analysis on their own. So although even though these softwares that were developed, they use also programming languages. Yeah. So that is quantitative risk analysis. And if maybe at individual level, I can develop a model on my own, like a simple mathematical model that I can use to mitigate risks on my own. So I don't require using computer system or something like that, because my case is simple. For example, think about maybe analyzing a risk of or assessing a risk of buying a cell phone. I mean, you can do that on your own without making the model complex. Yeah. So in a case where you have a large data, for example, a whole insurance company, they want to assess their risks or their probability of ruin. We call it ruin probability. Or they want to know their solvency, or they are afraid of some regulatory fine in their business operation. So in this case, for this regulatory issue, it can be a qualitative risk assessment, because it could be just a subjective opinion or by compliance and stuff like that. But when we talk about assessing probability of ruin, maybe using any model, because there are so many models we can use to assess the probability of ruin. Yeah. So, or doing some solvency analysis. This can be done maybe annually, yearly, and of course, it's a mandate. Even not from the compliance perspective, even for the company operation, sustainability itself, they need to perform solvency analysis. And this solvency analysis is all part of risk assessment. Yeah. And then, yeah, so that is that one. Then we look at quantitative risk analysis specifically, just like I explained earlier. It requires mathematical models. So in some cases, you assign a numerical value to a risk, and you will have so many possible outcomes. And one of the examples we use in quantitative risk analysis is called a Monte Carlo simulation. And this Monte Carlo simulation, it can be applied in several or in various fields, such as finance, engineering, sciences in general, and yeah. So in Monte Carlo simulation, we assign a numerical value, or it allows us to have so many possible outcomes for an event, probability of an event happening. You will see so many possible outcomes, and from there we can decide which one is which, or which one are we going to devise as a means of mitigating risks. Okay, so let's consider a scenario. These are just examples which we discussed last week. Let's say at individual level or at company level. The first example is applicable, of course, in general. If we consider a scenario of person deciding to buy whether a car insurance. So first, you have a car already. You bought this car, maybe new today, but you want to decide to buy insurance for the car or not. So yeah, this is kind of, let's say, individual level. Or even if you are operating as a company, you buy a lot of cars, maybe you are dealing with logistic, or you are dealing with delivery or Uber. Yeah, so you want to quantify the risks here to see whether it is financially okay or profound to buy uh, insurance policy for your car. So first, you need to identify the risks, such as accident, theft, natural disaster, and damage. Natural disaster and damage due to various reasons. So this case, to be honest, is a kind of very stochastic. But if someone look at it, you can, because in general, if we are developing a risk model, we try to make models as simple as possible. But if we want our model to, we want to appreciate the capability of our model, we have to make it more stochastic, consider several variables. But at company level, you see that we always want to make things or model as simple as possible. The more you reduce the parameter on the model, the more simpler it will look. But the more parameter you include, the more complex the model will look, and it can result to some error. But if it is well developed, it actually bring sound result compared to the one with the less number of parameters. But of course, we will see how we can do this kind of analysis with model with much parameter and model with a smaller number of parameters. There are approach, of course, we will learn them in the future. So, and then the second step here is data collection. So you just need to have some historical data. Particularly for this case, you need to have statistic of number of accidents that happen, or number of cars that were stolen in your area or within your business terrain. And then, having this information, you can use this data to calculate the likelihood of car accident to happen, and also to calculate the likelihood that someone will steal your car. Yeah. So also, if you have sorry, if you have wait, if you have data related to weather, you can also calculate the probability that your car will be damaged as a result of weather condition. So, for example, every year there is heavy rainfall, and then which result in flooding, and a lot of people lost their car, or the rainfall damage the road, so there is no good road, and then your car can be damaged, your shock absorber can break or something during your operation. So yeah, so risk measurement. Then after you have all this, then you need to measure the risk. So by the time you have the outcome of your analysis, that is when you can measure the risk. Yeah. So you can measure the risk based on the probabilities of some certain event happening, or based on the financial loss. Yeah. Okay. So after you measure the risk, then the last step is to make decision. So making a decision using analysis, using the analyze the result, or the result of the analysis, the individual can compare the possible financial loss from this risk to the cost of insurance premium. So in this case, we are talking about buying an insurance policy. So if you compare, and then it turns out that it's worth buying a car insurance, then you buy. If it turns out that it doesn't worth buying a car insurance, then you leave your car without insurance and continue your operation, and then you have like a very low chances of losing or damaging your car, and then the whole money for buying the insurance is saved. Yeah. Okay. So let's see the next slide. Okay. So here, consider a scenario in which government is preparing to start a large-scale infrastructure project, such as constructing a new bridge or road. So these are also a way we can analyze risks. So as an individual or government, you want to initiate some project, you need to assess the risks. So they either perform they can the risk analysis can be both at the same time. I mean, you can do quantitative and qualitative risk analysis at the same time, depending on the scenario. Some scenario require just quantitative risk analysis, some scenario require just qualitative, but some scenario require both. So it's acceptable. I mean, it's more good to consider doing both in a case whereby two can be applied. Yeah. So yeah, here in this case, if someone or government want to embark on a new project, then they have to perform the risk analysis, and the steps are the same as far as the quantitative risk analysis is concerned. So the previous step that we use can be applied here. So for example, I like let this as a task. Based on the above scenario, outline the step to be taken by government in in quantitative risk analysis of the project. So whether you consider it an infrastructure project, uh, such as constructing a new bridge, or it can be even a policy, maybe poverty reduction initiative, or maybe improving security. Yeah. So a lot of things. All right. So before going here, I would like to just show you something which I feel is important. Um, uh, when it's come to risk analysis, there is a recent, let me say, development concerning the self-driving cars. Maybe I know many people are aware of this, even though some people maybe didn't see this case yet, but yeah, there's this kind of development. But as risk analyst, even not looking at compliance perspective or regulatory perspective, because some countries may accept it, some country may not accept it, depending on the kind of infrastructure provided. This car may not operate in some countries, yeah. And then, but in general, we can able to see some risks connected to this kind of um, self-driving cars. So if you happen to be a CEO or a manager of any technology company and you want to do anything, then you need to actually look at the potential risks that will happen when you embark on a certain project, especially cyber attacks. So I will show you one thing here. Wait, let me try to. I will stop presenting for a second and then I will present again. Just want to show you what happened with some project. Mm, okay. I will share my screen again. Um, okay. I'll just share the entire screen just for you to see. Mm, can you see this YouTube page, the online page? Can you see, please? Someone should confirm.
Yes, we can see. It's playing.
Okay. So I don't know if you can hear the sound as well.
We can't get the sound.
Yeah. It's, so this one I can explain to you what happened. This is Jeep, and everybody know Jeep is very famous car. People use it a lot. But the funny thing, what happened during this period is that this car was hacked. This car can be hacked because there are a lot of computing system in Jeep. So someone can use maybe their laptop to hack the just stop the engine while you are in the middle of driving, which can cause a lot of harm. So that is what happened in this case. The guy is driving on a highway, and some guy sitting at home just hacked the car and stopped the engine eventually. So imagine this is a not a self-driving car, but it has a driver, and there is a potential hack, and then which can cause accident or even loss of life. So imagine using using a car that is driverless. There is no driver. Yeah. So yeah, that is things that happen. So the guys just stop the engine, and they can play music. They can just distract the driver at some point. Yeah, so you can take these videos maybe later if you want, so you will see how it happens. So this is kind of risks that are involved. So I'll stop sharing this one and then we can continue. Yeah. So far, do you have any question? Hello, can you hear me?
Yes, we can.
Yeah. Do you have any questions so far?
Not from here.
Okay. All right. So yeah. So here we are just going to repeat this a simple model. So this model is a general model we use for assessing some risks of some certain event happening. So expected monetary value. So this expected monetary value, because by the time we start doing more of quantitative work, we will be using this expected value. We call it expected value, or we call it expected monetary value. Some people also call it like if face value. Yeah. Okay. So the expected monetary value is a simple formula, just the product of probability of an event happening times the financial loss, where L here, Li represent the financial loss, and then Pi represent the probability that a risk is occurring. Okay, so to calculate, for example, considering the case of a car insurance, if we want to determine the risks involved or the expected loss, here we can just sum up the probability of all this, the monetary value involved in the event of, let's say, the car is damaged, or due to weather, or there is accident, or someone stole the car. So we put together all these three probability then as a sum, multiply by the expected financial loss, and then that way we can be able to know that is our expected monetary value total. Yeah, so I'll move to the next slide. So taking an example, so for example, let's consider three main risks without a car insurance. So you don't have car insurance, there is possibility that accident will happen within a year with probability of 0.1. And then if that occur, you will lose $5,000 because you need to repair the car. That is potential cost of the repair. It can be higher. So, okay. Um, Please go ahead, Mr. Ibon. You want to say something? Are you there?
Hello?
Yes.
I feel a bit upset over this class because
Okay.
the last time I joined, you said yourself that we're starting 7. And recollect confirming with Alima that is it exactly 7 so that I can go with other things. And she said yes.
Yeah.
And now the class has commenced even before 7.
But sorry, I think there is conflict between the timing. You know, we are using Nigerian time, and then we are,
Yes.
yes. So this is 7:38 in Nigeria, and it's the same time here in Poland. So it's
Okay.
different from UK time.
Okay.
So apology for confusion, but I think UK is 1 hour ahead of Nigeria, right? Or 1 hour. Nigeria
Behind.
is 1 hour.
Behind.
Okay, behind. So
Behind.
that is why. So
Okay.
yeah,
All right.
that is a problem. So please, not that we are using Nigerian time.
Okay.
Yeah,
And I
and
hope the
yeah,
class is recorded as well.
yes, it's recorded. I mean, we are just repeating what we have done last week for
Okay.
the sake of
All right.
those that missed the class. So,
Okay.
and everything now is recorded. And
Okay.
apologies. Thank you for pointing out.
Okay. All right.
Yeah. Okay. So let's continue. Here we have probability of theft within a year of 0.05. So you see it's very small. And then financial impact is 15,000. So you see it's a very big money, because when you lose the whole car, you need to buy a new one. Then, so probability of weather related damage is 0.15. So a lot of them. That is why you can see that the probability is higher compared to all others. But we have a smaller amount of money, because this damage can just be maybe a small damage, but if it happens several times, you will lose so much money, a big amount of money, because let's say it has to be happening, let's say every 3 months in a year. Then if you multiply this, we have 4 quarters, multiply by 4 is like $12,000, almost a new car. Yeah. Okay. So we have this input. These are the input. These are what we need to input into our model and see the outcome. So this way we use this formula, the previous formula I have showed you, then we just multiply the probability times the expected loss, probability times the expected loss. So one can tell me, we are all mathematician here, why here we have like 15,000, here we have 750, here we have 5,000, here we have 500, here we have 3,000, here we have 450. Yeah, so where we have like a very small amount of, we have a very small amount of money here, but yeah, still we have smaller amount of money. But the probability is actually what determine the cost in general, because it's a product. So if we have the higher the probability, the higher the loss. Yeah, and then the lower the probability, the lower the loss. So the two are related. So therefore, the total expected monetary value of potential losses without insurance is determined as this. So we determine it as $1,700. Assuming the insurance premium costs $2,000, what can we decide? So in this case, one can decide to buy the insurance policy, and one can decide not to buy the insurance policy. Let's say I think it's good for someone to buy the insurance policy, because considering just one probability here, probability of um, damage from weather related issue is a bit big, and there is chances that one of this event will happen, let's say twice or three times in a year. So if for example, even if it happened like three times in a year, although the money is still less than this, and consider that there's chances of one of this also happening. So yeah, it depends on you, but you have all the data, all the necessary result that you can use to decide. No one can say, it's kind of subjective. No one can tell you, okay, this is what you should do, except if you have more parameters, more things that you need to put into consideration that will influence your decision of buying a car insurance or not buying a car insurance. Yeah, so here I just put a snapshot of this. So we are going to just move forward. This is just the snapshot. I don't know if Osahon, you try, or Ibon, did you try running this code from your own end?
There's no way I could do that because we're not
Yeah.
sending any, what's it called? Oh, you mean with the Python lesson class?
No, I mean personally, if you try to run this code.
No, I didn't. Except if I might have to try it with the Python
Yeah,
course.
please, you can just you'll find it interesting. Just take a look at the code, how it is. I know some of this were not covered during because it's just an introductory classes, especially how to define a function. It's not
Yeah,
covered during the class, but yeah, if you put the code the way it is, you should be able to understand. I
run
put
it.
also some comment just to understand what is happening, or what each line of code is doing. Yeah. Okay. So
All right.
that is that one, and it takes like 0. You can see that is the importance of using computer. If one need to calculate this, at least, even if we see that is simple addition and multiplication, but it
Yeah,
takes some time. But when you put everything in code, it takes just 0.1 second to run.
seconds.
Yeah.
Okay.
Okay. So now another example we have here is, suppose an individual is considering investing in a particular stock and want to assess the risks associated with potential price fluctuation. They decide to use simulation to model different scenario of stock price. So the simulation we are considering here is called geometric Brownian motion. So because stocks are very volatile, they are things that changes at any time. So that is why we have this geometric Brownian motion. When we use geometric Brownian motion, we use it in a case whereby there is a very frequent fluctuation. Yeah, so stock price is one of the major examples. So we don't know what stock. There are many stocks. So it can be any stock. It can be Tesla, it can be Apple, it can be Amazon, or all the London stocks or any stock. Okay. Yeah. So in this case, we use this formula, and this formula is not like very complicated formula. The more parameters we put, the more complicated a formula will be, a model will be. So here we have the price in the future. That is our target, because we want to determine what the price will look like or what the price will be. It's a predicted price, not the exact price, but there is, let's say, 99% chances that if your model work well, that the price could be that you model in the future. So here we have the initial price S naught. So here we have, because it's geometric, you see we have this exponential. We know how geometric formula look like. So it's an exponential function here. And then you have mu, which is just a parameter. We have sigma is also a parameter. So these are the things we have. And then we have t, which is time, and then z is a standard normal random variable, which we drive it or we use it for a standard normal distribution. And this, there is a package for it in Python. Python can do this for you. There's a package, you don't need to provide this input. So it's just to put the the function, and then it will generate automatically. Yeah. So this is the formula. So here in this slide, we just have the step on how we can use this Monte Carlo simulation. So the simulation process aids in assessing the probability of various price movement, analyzing potential gain or loss, and measuring quantitative risk metrics like the expected return and standard deviation for informed decision making in investment scenarios. So yeah, but there are always input, because in general, the global scientific rule is that we move from a known to discover the unknown. So if you have to put some parameters, you know, today price, you know, the rate of volatility, the drift, you know, the time for which you want to predict the price, then you put this as an input. And one thing, let me say, the shortcoming of models is that the more uh, good the data are, the more the model will perform. So the model cannot tell you that your data is not good. It doesn't care. It doesn't even know. So it's only when you provide a good data, then you can have a good outcome of your model. Yeah, so this is also like just uh, Python code we use to perform the computer simulation here. So we use NumPy, and we, as you can see also here, it takes like, we have like 1,000 number of Monte Carlo simulation, 1,000 step. So, and then in this 1,000 step, you can see it's also execute within 1.7 second. So even less than a minute. Yeah. So by doing that, we print out so many prices in the future. And then for people that trade, this is good. If you are analysts in trading, you can be able to estimate, even if it is a cryptocurrency or even forex market, you are maybe trading dollar to euro or euro to dollar or to GBP or to CHF or any currency. Then if you know some price and some of these parameters, you can be able to estimate. Then you will know whether to buy or to sell or to hold a position. Yeah. So that is it. And then here we have the result of the code. So just here we have the price movement, we have the time step, and then we can see what it is. Having this, then you will be able to decide. You can see it's not like it's a feature, but you only know the price today to be 100 as your input, and then you have so many kind of price fluctuation. So here this happened within 1 year, this kind of fluctuation within 1 year. So you can know your time step. You are using 1,000 time step, then it depends on how you define your time step, then you will determine which time this you will have a certain price, which time the stock price will be this, which time the stock price will be this. Yeah. So it's a kind of just way to have an idea of what something will look like in order to mitigate risks of losing money or to improve your chances of having an investment return. Okay, so far, do you have any question? Okay, please go ahead.
Okay, thank you. Looking at the risk assessment analysis that was done, I believe, yeah, I believe that some of it were based on assumption. In real life, if
Yeah,
it's close to accuracy, why is it that some of this what's it called, the stock traders are still failing and things like that? So is there more to it that we can understand?
yeah, but many stock traders doesn't do the analysis. They Some people depend on news, which is very wrong. I know Nigerians depend on news because I trade also. So and many people, we understand that in market, in financial market, one person can influence the whole market.
Yeah.
For example, if you are a politically exposed person or if you are a businessman, especially in Nigeria, it's easy. If someone maybe, or if government pass some policy uh, connected to dollar, you will see that the dollar rate have changed. So people most that is why many traders fail today. People relies on just news. Some rely on outdated news. So it's not a good approach. If you are a trader, you have to keep your eyes on news also. Very, very important. But
Okay.
the best way people get it right is by performing this kind of mathematical analysis.
Yeah, that's what I'm saying. Those
It's not
the
reality.
formula,
Yeah.
and if you go back to the formula, before the what's it called? The
Yeah.
Yeah, there are loads of. So how do you determine the volatility? I mean, is this something you can
Yes.
just get by calculation or by assumption?
No,
That's
you
what.
can assume it. You can assume it first, and
Okay.
then you can, for example, you can tell the market how volatile dollar is in Nigeria. You can tell
Okay.
looking at the historical data, looking at
Okay.
how it is changing.
Okay. Using time series.
Yes, time series. People
Yes.
mostly
Okay.
use historical data.
Okay. Okay.
So before they base their assumptions, so many. In fact, for your model to work well, all your assumptions should have basis.
Okay.
Yeah, if you have a basis for your assumption, if the basis is strong, then your assumption is close to reality.
To accurate. Yeah. Okay.
Yeah,
Okay. All right. Thank
yeah,
you. Yeah.
no problem. So that is that, and thank you for the question. Okay, so yeah, last week we stopped somewhere here, and today we are going to proceed. I can see we still have some time. Please let me know if you need some break or you have some question or you have some comment. Please don't feel free to interrupt me at any point in time. So let us look at qualitative analysis. What we have been discussing is quantitative analysis. Although qualitative analysis is, let me say, quantitative is superior than qualitative because most of the things we do today are kind of complex, especially finance and insurance. It's a very complex, complex situation, very, very complex. So mostly quantitative risk analysis do well in such cases. But qualitative is also important. We have risk management at some level, administrative level, compliance level. Then we have to also consider qualitative risk assessment. Yeah. So qualitative analysis of risk is an analytical method that does not rely on numerical or mathematical analysis. Instead, it uses a person's subjective judgment and experience to build a theoretical model of risk for a given scenario. A qualitative analysis of a company might include an assessment of the company management, the relationship it has with vendors, and the public perception of the company. So you see, it often employ when quantitative data or precise measurement are not available. when initial risk identification and assessment are needed. Yeah, so let's say you want to open an insurance company in Nigeria, or you are operating as an insurance company and you want to bring out a new product. Let's say you are just giving health insurance, and this time around you want to bring property insurance. First, you need to do some risk analysis. Let's say compliance perspective, you need to look at regulations. How much are you supposed to have? How much money you are protected? Are there companies in Nigeria that can reassure you? Yeah, because the funny thing in insurance, even the insurance, we always try to distribute risks, because even the insurance market, the insurance company, there are people that insure them also. They also buy their insurance from another people just to distribute the risks, which we call insurance. And we'll look at it when we start, in the future, I mean, when we go deep into the course. So in this case, qualitative, you don't need to do any mathematical model for this, because you look at how much of your money is protected if you invest in a particular, let's say, company. If you put your money in the bank and then at some point the bank went bankrupt, did you lose all your money, or you will have some money being protected? You see that every country have this. I know about the National Deposit Insurance. So those guys are responsible for providing how much money will be protected in case of being at ruin. So even insurance company look at this. So these are all kind of qualitative risk assessment that companies did. Yeah. So yeah, and many of them at organization level or individual level, so many let's say basic or initial risk identification and assessment are required before going into quantitative risk assessment. Okay, so the steps, as we mentioned earlier: brainstorming, interviewing, DLP techniques, historical data, strength, weakness, opportunity, which we call SWOT analysis in short, risk rating. So many things. You have brainstorming issue, you discuss with management, you discuss with an audience of colleagues, looking at so many issues, considering so many things, because it's always important to brainstorm when you are doing qualitative risk analysis. It's not like a one person activity. You need to involve maybe expert, people with experience. If you have some money, you want to invest in some stock, or you want to open some certain company, you need some consultation. So all this kind of consultation, some brainstorming are part of qualitative risk analysis. Historical data. So historical data, looking at the past, what happened, and then what data will tell you. So this, let's say, is a kind of involve some, let's say, quantitative risk analysis, but at data level. Even because you have huge data, you happen to work in an insurance company, and then you are presented with a very large data, and you are asked to, based on this data, analyze the risks. Let's say you have data on people that, uh, let's say, show up for a particular disease, and then you want to analyze, based on this historical data, the probability that um, people will show up for that same disease in the future, or how much this the premium of this particular disease will be, if maybe you are talking about pricing. Yeah, so in this case, also at this data level, you need to perform some basic data analysis, which will give you more insight. So this is what we'll be doing mostly during the seminar, having some real data from insurance company, from Society of Actuaries, or any other source, and then show how to analyze this data at company or individual level. So mostly we'll be using techniques. That is why I strongly encourage us to be to familiarize ourselves with Python. I mean, one will look at it like a rocket science. To be honest, it's not. Python is easy. It's just algorithm. If you write, it give you garbage in, garbage out. But please don't consider it as very big thing. Just try as much as you can to start learning how to write some code. It will help, of course. And by the time you experience some difficulties or any challenges, just feel free to give me a shout, and I'll be happy to support. Yeah. So yeah, the next one is strength, weakness, opportunity, and threat analysis. SWOT analysis is also to determine the weakness, the strength, the opportunity, the threat of some certain scenario. So risk rating scale. So this also may require data. For example, you want to invest in Nigeria. Maybe you are living in another country. You want to, or even if you are living in Nigeria itself, then you want to invest. So you need to look at some rating. For example, corruption perception index, where Nigeria is placed. Yeah, and then even protection. Look at, let's say, some kind of if you are into banking, some Basel requirement, and see if banks have done all those or have met up with all those Basel requirements. A lot of them, I know we have up to Basel 3, and if you look at them, they are very strict, very strict, very strict policies that central bank have to be serious about. But I think they are not very serious about it. They don't even care of so many things happening in the market, and that is why you can see uh, we have issues even with our currency. It's not only politics. I mean, so many factors. Even without politics, central banks should be operating as an independent entity. Yeah. Okay, so I'll move to the next slide. Do you have any question before we proceed? I can see someone write something in the chat. Let me try to find where is the chat box. Okay, here. We talk about geometric Brownian motion being used to model stock prices in PSM. Can we have material that will give a gentle introduction to the geometry? Yeah, I mean, I will give you some books that we'll be using for the course. So if you have some time, you can read them. Yeah, for this, I can also provide material. There's one book, Computational Finance. Then you'll find more on geometric Brownian motion. And thank you, Kahinde Bello. Okay. So let us look at example of qualitative risk analysis. QRA means qualitative risk analysis here. A hospital is implementing a new electronic health record system. So, which I think is important in Nigeria. I mean, this health record system. And then what will they do? They need to identify, they need to take some measures, some step to identify the risks involved. So first, identifying risks, conducting workshop involving uh, people, clinician, IT specialists, and administrative staff to identify potential risks such as data security breaches. Yeah, because one of the issue, I think a very critical issue, is data breach. You want to create a data record system, you have to be sure that maybe the storage, for example, you are collecting some patient personal information. You collect patient personal information and you retain them for maybe 2, 3, 4 years, which is not maybe allowed in some data regulation um, policy. So you need to be sure of if system can, maybe the kind of record system you want to implement in your clinic or in your hospital can automatically delete this data after some certain period of time. And if there is a good auditing or regulatory checking and they find out that there are so many breach, probably they may fine you a money more than the money you spend while developing this electronic health record system. So it's important. identifying the risks. Don't just look at the benefit or the impact, the positive impact of the project, but also the negative impact when something does not went right. Okay, so analysis here utilize SWOT, just like we mentioned, analysis to assess the strength, weakness, opportunity, and threat related to the new system implementation. So expert judgment. This can be done at very first stage, that is during the brainstorming, or you require consultation and stuff like that. Gathering insight from IT expert, healthcare providers, and data security professional to evaluate the severity. You know what it is, severity of risks, and develop mitigation strategy. Okay, so I think that's the end of the slide for today. Do you have any question? I believe by now everyone have this material, right? So I will develop, I will prepare second material and then, yeah, share with you after the next class. So I think we are meeting next week. Shahabil, when is the next class? Yeah, please go ahead. I see your hands.
You mentioned that this material has been supplied. Is it?
Yes,
Uh, I
it's
don't think.
uploaded, and some student confirm that they have access to it. If you don't, I can send
I
to you, I mean, privately. If
I
you
will appreciate that, please.
sure, I'll send
And
it to you immediately after this.
yeah, and how do we? Is the LMS working now? No.
I I
Yeah,
think
it
yes.
is working. The
Yeah.
LMS is working actually.
Okay. So are we going
Elias,
to?
have you tried uploading the material on the LMS?
Yes, I
No.
upload this, and
Okay.
some student told me that they can download from LMS.
Ah,
Yeah, I'm sure
okay.
it's quite working. So maybe you need to check. And if you need
Please,
any
can you
guidance,
resend the whole thing, the packet? Because the first time you sent it and I tried it, then it wasn't okay. And
Mm-hmm.
Elias said we should go through the Google Meet. So maybe you should resend it so that we can reaccess it. The LMSS, what's it called, platform.
Yeah.
Yeah, so that I can. And then the recording should be on the LMS as well. That's why I'm even asking
Yes.
about the
Yes.
LMS.
Yes.
Yes. Okay.
So
Thank
Tahin
you.
Develop doesn't have it also, so I'll drop it in the group so that everyone can download.
Yes. Thank you very much.
Yeah,
All right.
thank you. And
Okay.
do you have any other question? So he's also asking, how do we access LMS? Sharabilu, you guys should please send them the guide on how to do this.
Yeah, that was what I was saying, that they should send the guys to us so that we can
Halima, are you there?
reaccess.
Okay, so I'll
I'm here,
okay,
sir.
so I'll please inform Chisom to please send the LMS instruction on how to access it. Okay.
All right.
Yeah. Thank you.
Okay.
So any other thing? And please, how do you find the class? Although it's just the beginning, it's kind of introduction. So just let me know if something need to be adjusted or amended. Okay. So I will maybe consider no. Okay. So no any question?
No question. But for me, for now, like, have any observation?
Sorry. Can maybe your mic, you can come close to your mic. I can't hear you very well. You just mentioned that you don't have any observation, right? If I hear you correctly.
I said for now, there's no observation. The class is okay. But
Okay,
if
okay.
you,
So we will do as much as we can to improve. So I will make the material as friendly and as more real life scenarios as possible. Okay, thank you for your uh, participation, and
Then
please.
are we still
Sorry.
having the next presentation today?
No, no, no. This is the last one.
Okay, all right.
Yeah.
Thank you.
Thank you. Bello,
I think Kanye was raising up his hands.
sorry, yeah, Bello, I see.
Okay. Thank you very much. I think Osahan actually spoke to uh, what I was actually going to say, which is
Okay.
just basically thank you, Elias
Mhm.
Toko. I think
Yeah,
for me, I really enjoyed this. I mean, it's really very clear that you not only just went through the material, you actually spoke from depth of experience, and I think that for me is really commendable.
yeah,
So just keep this up, and I'm hoping that at the end of the day, we will all get the skills set and the knowledge
yeah.
that you are trying to pass on to us. Thank you very much.
Yeah, no problem. Thank you for your comment, and it's kind of generous. All right. So, good day, guys, and then enjoy your day. Have a nice evening.
Thank you, Ilyasu.
All right. Cheers. Bye.
Yeah, bye bye.